Welcome to FXTech's comprehensive NZD/USD analysis for the week of October 27th through November 1st, 2025. In this presentation, we'll dive deep into the technical and fundamental factors driving the New Zealand dollar against the US dollar. We'll examine critical support and resistance levels, analyze the impact of central bank policies, and provide actionable trading strategies for both short-term and medium-term horizons. Whether you're a day trader or a swing trader, this analysis will equip you with the insights you need to navigate the current market environment. Let's get started with our in-depth examination of one of the most volatile currency pairs in recent weeks. The New Zealand dollar has earned the unfortunate distinction of being the worst-performing G10 currency in the second half of 2025. As of October 31st, NZD/USD is trading at 0.57252, reflecting persistent weakness across multiple timeframes. The one-week performance shows a decline of 0.91%, while the one-month performance is down 1.58%. Looking at the six-month picture, we see a significant drop of 3.76%. Despite these losses, the year-to-date performance remains positive at 2.35%, suggesting that the weakness has accelerated in recent months. Technical indicators show a neutral stance across both oscillators and moving averages, signaling consolidation after recent volatility. This neutral technical setup, combined with deteriorating fundamentals, creates a challenging environment for NZD bulls. 8 major catalysts have shaped NZD/USD's trajectory during this period. On the bullish side, we have two key factors: the US-China preliminary trade deal announced on October 26th to 27th, which boosted risk sentiment, and the improvement in New Zealand business confidence shown in the ANZ survey on October 30th. However, these positives are vastly outweighed by 6 bearish factors. The Federal Reserve delivered a hawkish 25 basis point cut on October 29th, signaling uncertainty about a December rate cut. The RBNZ maintains its dovish bias with a 91% probability of another cut in November. Additionally, the NZD's status as the worst G10 performer, the US government shutdown clouding economic data, the sideways trading phase between 0.5750 and 0.5790, and China's PMI falling to 49 all contribute to bearish pressure. The net impact is clear. Bearish forces dominate despite temporary relief from trade optimism. Understanding key technical levels is crucial for successful trading. On the resistance side, we have 4 critical levels to watch. The immediate short-term resistance sits at 0.57765, followed by the key breakout level at 0.5780, which was previously resistance and has now turned into support. The psychological barrier at 0.5800 represents a significant hurdle, while the major resistance target lies at 0.5850. On the support side, immediate short-term support is found at 0.57690, with the sideways range support at 0.5750. The upward trend line on the 4-hour chart provides additional support. Currently trading at 0.57252, the price is below all major resistance levels, suggesting that bearish momentum continues to dominate. Traders should watch these levels closely for potential breakout or breakdown scenarios. For short-term traders looking at a 1 to 2 week horizon, we have 2 distinct strategies. The long strategy targets entry between 0.5750 and 0.5769, which represents the support zone. The target range is 0.5800 to 0.5850, with a stop loss at 0.5740, providing a favorable risk-reward ratio of 1 to 2. The short strategy, which we favor given current bearish fundamentals, suggests entering at the 0.5800 resistance level, targeting 0.5750, with a stop loss at 0.5810. This offers a risk-reward ratio of 1 to 1.5. Key events to monitor include Fed policy communication, following their hawkish cut, US-China trade developments, and the crucial RBNZ meeting on November 26th. Our recommendation is to favor short positions given the bearish fundamentals and technical setup. Remember to implement strict risk management on every trade. Looking at the medium-term outlook over the next 1 to 3 months, we assign probabilities to 2 distinct scenarios. The bullish scenario, which we give a 40% probability, requires the Fed to signal more definitive rate cuts, the RBNZ to turn less dovish than expected, and US-China trade relations to show further improvement. If these conditions materialize, the target range is 0.5900 to 0.6000. The strategy would be to buy on dips at the 0.5750 to 0.5769 support zone. However, the bearish scenario, which we assign a 60% probability, appears more likely. This scenario assumes the Fed maintains its hawkish stance. The RBNZ delivers expected rate cuts, and China's economic data continues to weaken. The target range for this scenario is 0.5600 to 0.5700, with the strategy being to sell on rallies at 0.5800 resistance. Our base case is that the incremental downturn continues, as dovish RBNZ policy and weak China data outweigh trade optimism. Central bank policy divergence is a critical driver of currency movements. The RBNZ previously cut rates by 50 basis points, bringing the official cash rate to 2.5%, which is the lower bound of the neutral range. Their current stance is described as feeling their way forward with an easing bias. Market expectations show a 91% probability of a 25 basis point cut at the November 26th meeting, which would bring the OCR to 2.25%. On the other side, the Federal Reserve recently delivered a 25 basis point cut, but with a hawkish tone. The outlook for a December rate cut is uncertain and not guaranteed. This disappointed NZD bulls and triggered a sell-off from the 0.58025 high. The policy divergence impact is clear. The widening rate differential favors USD strength over NZD. This fundamental backdrop creates persistent headwinds for the New Zealand dollar. A balanced risk assessment is essential for informed trading decisions. Upside risks include a more dovish Fed policy pivot, a surprisingly hawkish turn from the RBNZ, and stronger New Zealand economic data. However, downside risks appear more substantial and include continued Fed hawkishness, further RBNZ easing as expected, China's economic deterioration, and potential global risk aversion escalation. Current market dynamics show a choppy, sideways trading phase has been established, with fast fluctuations as institutions adjust their perspectives. The pair is correlating with broad USD strength, and we're seeing split Asian sentiment with Japan and Korea surging while China lags. Our assessment is that downside risks currently outweigh upside potential. Traders should position accordingly while maintaining flexibility to adapt if conditions change. Successful trading requires discipline across 4 critical pillars. First, strict stop losses. Never risk more than 2% of your account on any single trade, with no exceptions even for high conviction setups. Second, position sizing. Avoid heavy positions in a single entry and scale in gradually at key levels. Third, news monitoring. Watch Fed and RBNZ announcements closely, track US-China trade developments, and monitor China's economic data releases. Fourth, flexible adjustment. Adapt your strategy to changing market conditions. Don't marry your positions or predictions, and react to price action rather than emotions. The critical reminder is that market conditions change rapidly, and proper risk management is non-negotiable. These 4 pillars form the foundation of sustainable trading success. Implement them consistently, and you'll be better positioned to navigate the volatility in NZD/USD. In conclusion, our analysis points to a cautious bearish bias for NZD/USD. 5 key takeaways. NZD is the worst performing G10 currency in H2 2025. The RBNZ's dovish stance continues to pressure the pair. The Fed's hawkish cut disappointed bulls and strengthened the USD. The technical setup shows sideways consolidation with bearish bias, and China's economic weakness adds headwinds for NZD. For trading recommendations, favor short positions at resistance around 0.5800 in the short term, while the medium-term bearish scenario with 60% probability targets 0.5600 to 0.5700. Next key events to monitor include the RBNZ meeting on November 26th, with a 91% probability of a 25 basis point cut, the Fed's December decision which carries high uncertainty, and ongoing U.S.-China trade developments. This analysis is valid as of November 3, 2025. Trade cautiously and implement proper risk management. Thank you for watching FXTech's analysis.